Are we heading into stagflation? The warning signs are loud and clear. The risk is real. There is a real possibility that we could be heading into stagflation in the United States of America. There are certain things that we're going to be talking about on today's video. I have a packet of information. These signs are loud and clear. Stagflation could be coming. The risk is real. We need to know about it. We need to keep an eye on it, and we need to be prepared just in case this does actually occur. So what exactly is stagflation? Well, it's slow growth and high unemployment rate accompanied by high inflation, or inflation in general above the Fed's 2% target, which right now we are well above it at around 5 to 6%, depending on what metric you use. Now, we have had stagflation before. It occurred in the 1970s with the oil crisis. And the reason why I'm making this video is because what's happening with oil today is another warning sign that stagflation could be on its way, and we need to be prepared. Now, we need to be mindful of the actions that the Federal Reserve might take when we start to see slower growth in the economy and start to see unemployment rise. We are going to see a policy shift. And it is that policy solution for slow growth that tends to worsen inflation. As they pump money into the economy to help with the slower growth, that drives inflation. That monetary and most likely accompanied by fiscal policy, fiscal stimulus, leads to higher inflation. That's exactly what we saw during the pandemic with COVID. We saw huge monetary and fiscal stimulus, and that is why we saw inflation we haven't seen in decades. And that's what makes stagflation so difficult and so hard to fight, is because you're dealing with two different things. You're dealing with slow economic growth, which you're trying to correct, and you're also dealing with inflation. As you try to fix the slow economic growth, you fuel inflation. So when you have both of them at the same time, it's a horrible, horrible situation to be in. And it's a very scary situation. And it's a combination that shouldn't occur. In the logics of economics, prices shouldn't go up when people have less money to spend. It's as simple as that, and that's why we want to avoid it. So there are a few data points that I want to go over that are indications or signs that the economy is in fact slowing. And I think a lot of people know this, but the economy has been very, very resilient, but we are starting to see some more signs that it is starting to slow. The first one I want to go over is the March ISM manufacturing PMI, which dropped to 46.3 from 47.7 in February and trailed the 47.7 consensus. So it was below expectations. And this indicated a fourth month of contraction after 30 months of expansions, which is quite interesting that we've had such a long period of expansion and now we're starting to see that kind of decline. So with ISM manufacturing, new orders came in at 44.3 versus the 49.0 of consensus, so well below expectations. Unemployment 46.9 versus 50. That's also not good, below expectations. Now another sign, and this one's not as strong, not yet at least, but it is the first sign of weakness that we have seen in a very, very long time when it comes to job openings. So jobs have been extremely strong, and that's a good thing, and that's what's keeping the economy afloat, because 70% of the economy is consumer spend, which is driven by jobs. So as long as there are jobs, the economy has a very high chance of fighting off stagflation, because we can still see economic growth. Inflation, on the other hand, has been very sticky and very hard to deal with. But this jobs openings that came out in February was 9.931 million, which was below the 10.4 million consensus, which showed a little bit of a slowdown in jobs openings. So this is the first month where we're actually starting to see this contract a little bit. And this is a very important factor. Probably the most important thing when it comes to the economy is jobs and unemployment. So as long as jobs can remain somewhat strong, the economy has a good chance, like I said. But this sign is not welcomed because we do not want to see jobs really start to fall off a cliff. Because we know that jobs is a lagging indicator, meaning it's going to happen later in the cycle. The economy might stay strong and we might think that it's good because jobs, but this can change really quickly. It's usually the last thing that a company will do is start laying off people, and we'll start to see this in the jobs report. And when we start to see it, it's usually too late. So maybe this is the beginning of the storm, or maybe this is just 1 month of contraction and it will level out and just be fine. I don't know, but it's a huge sign that we need to keep an eye on. Now, there are two things that we need to consider, right? That when it comes to stagflation is the economic growth and inflation. And now I want to talk about the inflation part of it, because there was a huge event that happened over the last week that completely changes everything. And it is very scary. And the possibilities of this one thing leading to higher inflation across the board while we see some economic slowdown is real. And it's very scary. So we need to go into what goes into the consumer price index, known as CPI. And what I want to talk about right here is the fact that energy makes up 7.54% of the CPI. But as we know, if the price of crude oil goes up, if the price of gasoline goes up because of the price of oil going up, it's going to increase grocery, it's going to increase transportation commodities, it's going to increase household furnishing and supplies, it's going to increase apparel, other goods, alcoholic beverages, medical care commodities, and other things as well, because oil is used to transport and make so many different things. So if the cost of fuel goes up, the cost of goods go up with it. And there is a lot of reasoning to believe that the prices of crude oil can continue to rise. We're heading into a season this summer where travel is going to increase. So the demand for crude oil is going to go up. We also have the China reopening, which is sending it higher as well. Now, in this article, they mention that the US, and this is true, has already sold a lot of its emergency oil, which is also known as the SPR, or the Strategic Petroleum Reserve. And they are at levels we haven't seen since 1975. If you take a look at the chart for the amount of oil in the SPR, we really sold off a ton to try to keep prices low when they were skyrocketing because of the war in Ukraine and the whole speculation that happened in the oil markets because of that war. And very interesting what happened and why I believe OPEC did this surprise production cut is because the Biden administration said they were going to start refilling the SPR at around $65 to $70 a barrel. Well, we got to those levels, we got below those levels, and the administration was not buying back oil to refill the SPR. So business is business. OPEC Plus said we got to do something to stabilize the price of oil so that we continue to make money and our margins are good. So we're going to cut production to try to save or stabilize the price of oil, which sent it back up to a price where they are very comfortable. I think OPEC Plus wants at least or at around $90 a barrel in Brent crude oil. And it's not just me who thinks that. A commodity analyst at Goldman Sachs, because of this, increased their year-end price target for Brent crude, the global benchmark, by $5, increasing it to $95 a barrel, just shy of 100. And that would increase inflation or make inflation very sticky, very hard to deal with, and potentially put us in an environment where we have stagflation, which is why we are making this video. Pulled directly from this article, it states that the jump in oil prices might make the Federal Reserve's inflation fighting job a little bit more difficult, but it is too soon to know for sure. And this was what St. Louis Fed President James Bullard said in a Bloomberg television interview. So the people at the Fed are aware of this. They know that the recent jump in crude oil futures and the potential for higher oil might make their battle with bringing down inflation a little bit more difficult, and that could cause more economic slowdown as well. Now, and something else we need to look at, which is another indicator that we might be heading into stagflation, is the price activity in gold. And I want to read this article to you, or parts of this article, that is titled Why Stagflation Could Polarize Gold and Silver. Because what I want to show you is the correlation between higher prices in gold and the fears of stagflation, and why they go hand in hand. As we believe stagflation might be more of a possibility, the prices of gold are going to go up, because that's what they tend to do in stagflation times. Because gold is an asset that generally performs well in adverse economic and financial conditions. Now, pulled directly from this article, it states that they have seen 7.3 million ounces of inflows into global gold exchange traded commodities. In comparison, in the prior year, they saw a net outflow of 9.2 million ounces. So 7.3 million inflow compared to 9.3 million ounces of outflow in the prior year. And in that period of stagflation that we saw in the 70s, it states that between quarter 3 of 1973 and quarter 1 of 1975, the US GDP had been declining in real terms. And over that period, inflation rose from 7.4% to 10.3%. In the same period, gold prices had risen 73%. In the late 1970s, we also saw economic deceleration combined with accelerating inflation, with gold prices more than doubling in the calendar year 1979. So when we saw stagflation in the 70s, gold more than doubled. And what is gold doing now? Well, gold this month rallied into a 12-month high, and it is very close to its all-time high, and could potentially break out and soar to new levels. This might be a sign that investors are starting to think that stagflation is a real possibility, and they're looking at gold as a potential hedge, and that inflow of buying is sending the prices higher. So there you have it. In summary, we talked about what stagflation is and why it is so scary. We went over some indicators that the economy is slowing down, and you are starting to hear more chatter of a potential recession. The signs over the last month have been increasing, and there's a real possibility we could be heading into a recession. On the flip side, we still have sticky inflation, and what's happened with crude oil over the last week makes the Fed's job even higher. So could we potentially be heading into an environment where we're in a recession with high inflation, and that is, my friends, stagflation? And is the recent price in gold, the recent price action in gold, a potential signal that we might be heading into it, and those that are holding gold at this time might benefit from stagflation, at least in that asset class, at least in their investments that they have in gold. Now, if you've been following this channel and you're a member of the Discord, which you can get access to by joining the Patreon, a link is below, you know that a lot of my portfolio right now is in gold and short-term treasuries. And I'm not really buying more stocks. I'm hoarding cash, waiting for the opportunity to strike. And the money that I have to put in every single year because of Roth IRA limits, of contribution limits, I've been putting mostly in gold or short-term treasuries. This is because I think that gold is very attractive. Now, I wouldn't buy it right now because there might be a pullback, but we could revisit this discussion 6 months from now, and gold can be well above its all-time high. If it's not, that's okay, but the risk, I think, is well worth the reward, and that's why I've been putting money in gold and putting money in cash, waiting for opportunities to strike. Because I think this environment is very uncertain. I think there's a lot of risk still in the market, and I'm just waiting for a little bit more clarity, and when I feel a little bit more comfortable putting money to work. So that about wraps it up for this video, my friends. I thank you so much for your time. Please consider hitting that subscribe button, ringing that notification bell, and smashing that like button. I'll see you on the next video. This is We Are Investing, and I'm out. See ya.